Let's get to the broader markets here. We are at session lows. Dow's down 400. Goldman Sachs this week cutting its S&P target again, raising their recession odds due to all this uncertainty around tariffs. Joining us to discuss is David Kostin, Goldman Sachs chief U.S. equity strategist. He joins us here at Post 9 to discuss. Good to see you, David. Thanks for coming in.
How are you today?
Good. I was trying to remember the last time you guys were this far below consensus. Can you remember?
This far below consensus, well, with respect to the economics team, it's been
or earnings or S&P.
And earnings, we've generally been a little bit below earnings expectations for a while. Right now, we're looking for around 3% earnings growth this year. The consensus expectations for all the analysts, other strategists on Wall Street are 9%, so that's a pretty meaningful gap. Expectation is you're going to get a pretty difficult first quarter. Companies will be less, inclined to give guidance. Given a lot of uncertainty around how do you price products in an environment where the tariff situation is unknown. Even if we do get some announcements tomorrow, which of course we will, the question is what will the negotiation process be from that starting point? And so we've been focused a lot with clients on companies whose share prices are less sensitive to the three big issues that investors are focused on, which is the tariff risk, the recession risk, and AI risk. And one of the things that's not widely appreciated is the fact that the Magnificent Seven stocks are down 15% year to date. The other 493 stocks collectively are flat. That just is not part of the narrative. And one of the focuses individually, which stocks, some of the financial stocks, where all the discussions around the tariff uncertainty kind of ignore some of the opportunities that are taking place with regards to less regulations in the financial sector where maybe the dividend hikes are likely to be taking place. And you look at some of the companies like Bank of New York Mellon, State Street, where there's less sensitivity to those three big risks.
Right. Although now I'm beginning to see you guys fold in a big piece today about foreign boycotts of U.S. goods. And we don't really know what retaliation could or would look like. Where are you on adding that to the model?
Well, the model really driven, the most important thing is U.S. GDP growth. Global GDP growth. Other issues are also important, the dollar, FX, interest rates. But U.S. GDP growth is the most important driver of both revenues and ultimate margins. And so that's the key driver. We have Goldman Sachs' view that economic growth is going to be lower than consensus. Obviously, that's an important input into our model as well. And that's why we ended up reducing our earnings estimates, but also on the back of that is uncertainty. And the uncertainty that's been rising means that you have a greater risk premium, and therefore the multiple is going lower. The market started the beginning of this year around 21.5 times forward multiple. Today it's 20 times, and our forecast will be around 19 times in the next couple of months. And that increased risk premium, lower multiple, that's one of the reasons why the market near term is likely to go lower, might be by 5%, and then ultimately come back a little bit higher in the end of the year, but not a lot.
What about foreign investors? You have been traveling so much, and every time in the last few years, really, you've come back and said, everyone's really excited about the U.S. They're all putting money into the U.S. Are we going to lose that tailwind now?
Well, Sarah, on the margin, people are less inclined towards investing in the U.S. Around 18% of the U.S. market is owned by international investors. And that is
that's an important
That's the real source of the American exceptionalism, the attraction of the huge reinvestment that U.S. companies make compared with their counterparts around the world. So U.S. corporations invest like 40% of their cash flow back into their business to grow the business. That's kind of growth capex and research and development dollars. 40%. The rest of the market is around. The rest of the globe is around 25%. So that incremental returns, assuming it gets good return on their capital, is one of the reasons why the earnings growth has been greater here in the United States. Now you look into the current year, 2025. Our expectations, you get 4%. Earnings growth in Europe, you got 3% in the United States. It's an hugely unusual situation. We get actually faster expected growth probably in Europe. So on the margin, there's
faster expected growth in Europe.
Yeah, that's
because they have a weak euro.
No, because there's an expectations on the margin. Things are maybe some fiscal loosening, both in Germany and elsewhere. They're going to spend more money, and that could lead to slightly faster growth. Let me just be very clear. The absolute level of growth here in the United States is much greater, the absolute level of growth. But what's always relevant is what's priced, what's priced in the market. And the expectation is things are getting slightly less good here in the United States, getting slightly, relatively speaking.
But to Sarah's question.